Welcome to 6.3, our last section in Chapter 6 here, where we will be looking at how to do some financial analyses for our accounts receivable ratios. So we know by now that a business needs cash in order to run their business. They need to buy additional merchandise. They have to pay their operating expenses, which are the ones that happen every single month. So the reason that's so important and why it pertains to accounts receivable is that if we don't collect amounts due from customers promptly, then what it looks like is we have all these assets because accounts receivable is an asset, but we really don't because they're not immediately usable if our customers don't pay. So it's essential that as a business selling on account, we need to make sure that we ensure prompt collection from those customers. So the first thing that we're talking about here is something called an accounts receivable ratio. An accounts receivable ratio, or turnover ratio, excuse me, is the number of times the average amount of accounts receivable is collected during a specified period. So in order to do that ratio, we take our net sales on account divided by the average book value of accounts receivable, and that gives us our accounts receivable turnover ratio. So if when we did that calculation, we ended up with a turnover ratio of 8.3, that means that a company turns over or essentially collects the money due its average accounts receivable 8.3 times a year. Okay. Now, then another ratio we're going to look at is something called the days sales in accounts receivable. And so this essentially tells us the average period of time that it takes us to collect an accounts receivable. So that actually is where we take our days in a year and we divide by our accounts receivable turnover ratio. So you have to do the accounts receivable turnover ratio first before we can do this. And then that's going to give you your days sales. Now, sometimes it's referred to as days sales outstanding because that's essentially what it is. It's how many days outstanding our accounts receivable is. Now, the number of days sales in accounts receivable is always rounded to the nearest day because you could end up with like 62.4. In that case, we would round down to 62. And that level of accuracy is still going to provide the managers with enough information to make accurate business decisions about our accounts receivable so that type of a rounding is going to be okay. So we round to the nearest day. So typically, when we offer credit terms, we typically offer 210 and 30. So what that means, again, in case you have forgotten, is that we expect that most customers are going to take advantage of the discount, which is you get a 2% discount if you pay within 10 days. Of course, then we also have some customers who are not going to pay until the 30 days, which is where the N30 comes in, or the net amount. All of what they owe is due in 30 days. And others, of course, are going to go past that and have past due accounts. The longer the time required to collect on accounts, that obviously is going to explain why we could have higher than average collection period times, which is not ideal. So what this shows at the top here is a company's accounts receivable turnover ratio and a company's days sales and accounts receivable over the course of 7 years. So we have, you could say 2011, 2012, 2013, 14, 15, 16, 17, etc. And you can see how the accounts receivable turnover ratio went from 7.4 to 5 to 0.7, back down to 0.5, up to 0.9, up to 8.2 and 8.3. So anytime you're talking about the accounts receivable turnover ratio, we want that number to be higher. The reason being is that means that we're turning over our average accounts receivable more often. So that's a positive thing. On the days sales and accounts receivable here, you can see we went from 49, 49, 47, back up to 49, down to 46, 45, 44. When we are talking about days sales and accounts receivable, we want that number to go down because that means that that is a shorter time frame that it's taking us to collect from our credit customers. So we want that number to be smaller. So, as we've already said, if you were to do the calculation here, because you can, if you had the information, a turnover ratio of 12 times means that the company receives payments on average of every 30 days. Or if you take 365 divided by 12, that's what that accounts receivable turnover ratio is. Um, since the data that's given is usually higher than a company's credit terms of 210 and 30, the company should probably consider implementing some actions to improve quicker collections. Because you can see, even though it's 44 and it's gotten better, it could still be better because we would like to be able to turn that over on average of 30 days. Um, however, we have to think about, is it smart for us to change our credit policies against the fact that it could have on total sales? If you change your credit policies, is there a possibility that you won't have as much in net sales, which could affect your company in many other ways? So there are some steps that you could take to try to create better accounts receivable turnover ratio. One of them is to send account statements to customers more often, including a request for prompt payment. Maybe you need to send account statements twice before things are due and see if that helps. You could also try to not sell on account to any customer who has an account payment overdue of more than 30 days, see if that helps. And of course, you could try to conduct a more rigorous credit check on new customers before you extend them credit. But of course, even the most well sound out policies still could result in unfavorable accounts receivable. So that is our last lesson in chapter 6. We can head over and I'll see you in our 6-3 work together.